Last week, HIVE reported earnings, and it was a $148 million loss. But the stock is up 110% over the past 12 months. In a few minutes, I'm going to show you exactly what is buried inside the earnings filings. A few things I have not seen in a single other channel talk about. But first, let me tell you what this company actually does and what this year's numbers actually mean for them. HIVE runs 3 businesses, and understanding why they get different valuations is the whole game here. Segment 1 is Bitcoin mining. This is still 93% of their revenue. They mine Bitcoin using green energy, hydro in Paraguay, renewables in Sweden, and Iceland. As of March 31st, 2026, they had a 25.1 exahash of installed hash rate. That is up 6.3 times the year before. For scale, that is close to 4x expansion in the last 12 months. They mined 2,885 Bitcoin this year at fleet efficiency of 16.5 joules per terahash. Segment number 2 is Buzz, their HPC and AI cloud division. They run roughly 5,000 NVIDIA GPUs on the same data center infrastructure, $35 million in signed ARR contracts as of the earnings call. 2-year fixed terms, management guided HPC EBITDA margins north of 75% at scale. Segment 3 is the GTA Gigafactory. No revenue from them today. I will come back to this part in detail because the market's reaction to it is the most interesting analytical question of the whole story. Here's the full year of 2026 numbers. Revenue, $297.8 million. That is up 158% year over year versus $115.6 million in fiscal year 2025. Adjusted EBITDA, $72.9 million. Operating cash flow, $62.3 million. And the GAAP net loss, $148.4 million. I want you to hold that number in your head because in about 2 minutes, I'm going to show you that $221.3 million of non-cash items are sitting inside of that loss. The business made money on a cash basis. The cost is an accounting artifact. Q4 revenue came in at $71.8 million against a prior year comparison of $31.16 million. That is a 130% year over year growth in a single quarter. But before I walk through the entire income statement, there is something buried here that I have not seen anybody else talk about. It is in the risk factors section. I will show you exactly what it says in about 2 minutes. Keep watching. Let me walk through the P&L because the headline number is misleading. Almost every retail investor looking at this so far. Revenue, $297.8 million after direct costs. Gross operating margin is $170.9 million. That is 36.2%. Now, here's where it starts to get interesting. Adjusted EBITDA lands at $72.9 million, but the GAAP net loss is negative $148.4 million. The gap between those two numbers is $221.3 million. and nearly all of it is non-cash. Let me explain what non-cash means for viewers who may not know. Non-cash means cash did not actually leave the building. It is an accounting charge. It's real for GAAP purposes, but it does not reduce their bank account. The three primary non-cash items inside of HIVE's GAAP loss this year. First is their ASIC equipment depreciation. HIVE depreciates their mining hardware on a 2-year accelerated schedule. Other miners use 3 or 4 years. HIVE's choice is more conservative, but it front-loads enormous charges in the early years. The hardware did not stop working, it got fully written down on paper. And they did it fast. This gives them opportunity for massive margin expansion in the next few years once they are fully written off. Second, digital assets fair value changes. Bitcoin held on the balance sheet is marked to market every quarter under IFRS accounting rules. When Bitcoin pulled back in Q3 and Q4 of the fiscal year, those unrealized losses hit the P&L. Third, level 3 Bitcoin equipment derivatives. This is the most opaque item. I will cover it on the next slide. For now, understand this. Operating cash flow was positive $62.3 million. That is the real number. The $148 million loss is what the accounting says. The $62 million is what the bank account actually says. Stock-based compensation dilution, annualized at approximately 2 to 3% of the market cap per year. That is real shareholder dilution, even though it's non-cash. That matters for those of us who plan to be long-term shareholders, and we need to keep that in mind. Cash at year end was $47 million. Total debt $115 million in US dollars. That is the 0% exchangeable senior notes due by 2031. Let me spend a moment on this debt structure because it's not what it looks like at first glance. Recourse debt means HIVE, the parent company, is on the hook. There is no non-recourse firewall here, but, and this matters, the coupon's at 0%. 0%. That means no cash interest payments until 2031. For a company in a growth phase, that is extremely favorable debt. The conversion price is $2.57 per share. The capped call ceiling is $4.92. The stock is currently trading around the $4.50 region, which means it is right at the capped call ceiling. Above $4.92, the dilution protection from the capped calls weakens. That's something we need to consider. Share count has gone from approximately 165 million shares in Q3 2025 to 267.4 million shares today. That is a 61% increase in approximately 18 months. On a per share basis, every original shareholder has been diluted by roughly 40% over the last 3 years. That is not a deal breaker, but it is a fact that needs to be stated very clearly. The net debt, excluding Bitcoin holdings, is approximately $106 million. If you include the Bitcoin at current prices, it covers part of the notes. Not all of it, but a good chunk, about 10%. So slide 6. This is the part that I told you about. Here is what the 10K says. verbatim from the risk factor section, filed on June 2nd, 2026. The teaming agreement with Bell Canada does not guarantee the delivery of future revenues. The agreement establishes a framework for collaboration. It does not constitute binding commercial commitments. Let's let that simmer for a second. On the Q4 earnings call, HIVE disclosed that Bell Canada is paying $2.90 per B200 GPU per hour. The market and a lot of retail investors heard that number and started pricing in Bell Canada as a confirmed revenue stream. A $2.90 rate times thousands of GPUs times 8,760 hours per year produces a very large number, and the stock reacted accordingly. But the 10K says, in the risk factor section, this is the section companies use to disclose what might actually go wrong. What the agreement does not guarantee future revenues. It is a framework, not a contract. The only ARR that counts is the $35 million in USD in signed contracts with fixed 2-year terms. Everything else, the Bell Canada relationship, the $660 million target, the $2.90 rate per hour, it's all pipeline. It's not revenue. It's pipeline for now. The cash impact of this footnote is neutral. It is a risk item, not a current cash event. The overall market awareness on this is low. I did not find a single piece of financial YouTube content that surfaced before this video, and that's why we're here. Footnote 2, and this one is actually good news when framed correctly. The $148 million GAAP loss includes $221.3 million in non-cash charges. The loss is smaller than the non-cash items that caused it. Again, the non-cash charges are 149% of the loss itself. Operating cash flow was positive $62.3 million. The business is making real money. The accounting says otherwise because of IFRS digital asset rules and an aggressive depreciation schedule. Footnote number 3. Level 3 is the most subjective category in the fair value hierarchy. No observable market prices, no external verification. Management builds a model using internal assumptions, and the output is what hits the P&L. If Bitcoin prices decline materially in a future quarter, these derivatives will produce another large non-cash loss. Not cash leaving, but it will make the GAAP headline worse. If you are tracking this company quarterly, watch the direction of the level 3 derivative line. For insider activity, a board member filed an intent to sell 11,000 shares. The net insider direction over the last 12 months is modest. Net selling with no major purchases. My read on this at the time, it's all noise. It's really not any kind of signal. For institutions, multiple analyst price target upgrades post earnings. HIVE is mostly below the institutional radar, which is either a risk or opportunity depending on how the execution story develops. The two most important news events from the last 6 months, The fiscal year 26 10K itself, revenue up 158%, operating cash flow 62.3 million, and the Bell Canada footnote risk that we just walked through. The filing tells a different story from the press release. Event number 2, the GTA Gigafactory announcement on May 18th. HIVE acquired land in the Greater Toronto area. 21 acres plus another 4 acres. 58 million for land. 320 megawatts of power allocation already secured. The total estimated capex is approximately 3.5 billion Canadian dollars. As of June 4th of 2026, no anchor tenant has been confirmed. No project financing has been disclosed. No joint venture partner has been named. HIVE has land and power. Those are the two most valuable inputs in the AI infrastructure right now. But a $3.5 billion project still needs capital to become a building. The 3 macro and execution risks, a 30 to 50% Bitcoin price decline, which at 60,000 would put mining EBITDA near break even. The GTA financing gap, the project requires approximately 3 times HIVE's current market cap in external capital, and the Bell Canada ARR risk we already covered. The growth trajectory here is not subtle. Mining revenue went from 90 million in fiscal year 2024 to 106 million in FY25, 278 million in FY26. That's a 3x in 2 years. HPC revenue went from essentially 0 to 19.5 million Canadian dollars, and the signed ARR base of 35 million in US dollars implies the fiscal year 2027 starting point is already materially higher. The fiscal year 2027 estimate of approximately 390 million in mining revenue and 80 million in HPC ARR is not a management projection. It is a model assumption anchored to 35 exahash target and signed contracts only, not the $660 million target. Management credibility score, medium. They have been transparent about the non-cash nature of the gap loss. That is a pass. They have not changed their accounting methodology in a way that flatters their results. Another pass. The risk is the pattern of ambitious forward targets that remains uncontracted. The 660 million ARR target requires 19 times growth in approximately 30 months from a $35 million signed base. That is a vision, not a plan. We need to weigh forward guidance accordingly, but do not dismiss it either. So, tier comparison. Tier 1 is direct peers. HIVE at roughly $1.2 billion market cap. Hut 8 at 12 to 14. IREN at 13 to 21. And Mara at 5.3 billion. Same sector, wildly different valuations. The reason for the gap is execution, not aspiration. Hut 8 has 16.8 billion in signed AI infrastructure contracts. IREN has 3.65 billion in GPU financing. Has a 3.65 billion GPU financing deal confirmed. Mara is closing a $1.5 billion acquisition of Long Ridge Energy. HIVE has $35 million in signed ARR and land. Tier 2, if HIVE executes the GTA Gigafactory and scales Buzz HPC to 200 million ARR, the multiple set shifts from mining peers to data center infrastructure. Equinix trades at 17 times EBITDA to enterprise value to EBITDA. Digital Realty at 16 times. At 200 million ARR and 75% EBITDA margin, that is 150 million EBITDA. Times 16 equals a 2.4 billion enterprise value from HPC alone. More than double the total current market cap. Tier 3, HIVE versus Hut 8. Hut 8 has 16.8 billion in AI contracts and a 15-ish billion dollar market cap. HIVE has 35 million in signed ARR and a 1.2 billion dollar market cap. Same strategic direction, 10x valuation gap. The market is saying, show us signed contracts, not just land and power. That is the question that this investment really hinges on. To arrive at an intrinsic value for HIVE, I ran 8 separate valuation frameworks. Not because I need all of them, but because each one answers a slightly different question about what this business is worth and why. When multiple independent methodologies converge on the same range, that convergence is meaningful. When they diverge, the divergence tells you exactly where the analytical risk is. The discounted cash flow on the mining segment at a 12% WACC, reflecting the uncontracted commodity nature of that cash flow, implies approximately $3.95 to $5.41 US dollars per share. The DCF on Buzz HPC segment at a 10% WACC, using only the 80 million ARR base case, implies approximately $2.87 per share. The enterprise value to EBITDA model at 14.3 times, the adjusted EBITDA, the sector median for mining plus AI pivot peers, implies $5.96. Enterprise value to revenue, enterprise value to megawatt, NAV, and price to free cash flow all cluster in the $4 to $8 range per share. EPV, the no growth floor, assuming zero credit for any execution, comes in at $2.50 to $3.50. That's the bear case value if nothing develops. Blended across 8 active models, weighted by applicability, approximately $6 to $9 per share. That's not a price target, it is a mathematically derived range of what the business should be worth based on its current fundamentals, its peer group, and defensible forward assumptions. If you wanted to take an aggressive entry, it would be right around maybe current prices, about $4.50. You need conviction in at least moderate HPC execution. Mining cash flow can provide a real downside buffer for us. The patient entry may fall in a range of $3 to $3.50, near the conservative floor. It would require a Bitcoin pullback or a negative HPC news event. At this level, the 35 million in signed ARR alone begins to justify the valuation. And the catalyst-based entry might be worth it after they release a named GTA anchor tenant announcement or a second major HPC contract that materially grows the ARR base. Either of those events de-risks the execution story and potentially triggers a re-rating. That is what we all want. A sum of the parts model is the most intellectually honest way to value HIVE right now, because its business segments are fundamentally different, in fundamentally different stages of maturity, and they deserve fundamentally different discount rates. Collapsing them into a single multiple would obscure more than it reveals. Let me build this piece by piece. The mining segment, the contracted cash generating core, I'm discounting at 12%. These cash flows exist today. They are real. They are reoccurring, and they're tied to a commodity price. That is why they get the higher discount rate. Buzz HPC segment, partially contracted with $35 million in signed ARR against a $660 million target. I'm discounting at 10%. The contracted portion is real. The pipeline portion is a possibility, not a certainty. The model only values what is signed. Bitcoin holdings, 150 Bitcoin on the balance sheet as of March 31st, 2026, valued at approximately $10.8 million at year end. I want to be precise here because this is a number a lot of analysts have been getting wrong. HIVE mined 2,885 Bitcoin this year, but they sold nearly all of it. They're not a Bitcoin treasury company. They are a Bitcoin mining company that monetizes production as it goes. The 150 Bitcoin that they chose to hold at today's price of approximately 62,000, that holding is worth roughly around 9.4 million US dollars. Meaningful, but a small fraction of the overall intrinsic value picture. And worth noting that Bitcoin has pulled back significantly from the 107,000 range it was when the physical year ended. GTA land, the Canadian $58 million land purchase, converts to approximately $42 million in US. I am including the land at cost. The optionality of what sits on top of it, the 320 megawatts of power and $3.5 billion build, is not in this number because it's not funded yet. After subtracting the 115 million notes and estimated other liabilities, the base case for the sum of the parts implies approximately $6 to $9 per share, consistent with the blended model output. Now, here's the honest part. On the Q4 earnings call, management walked through their own sum of the parts framework using peer multiples, a 5.9x revenue multiple on cloud business like IREN, and blended Mara CleanSpark multiple on mining. They arrive at a Canadian $5.3 billion implied enterprise value as their downside case. Divided across 267 million shares, that's approximately $20 per share Canadian, or roughly $14.50 in US. At current exchange rates, and they called that the floor, not the target. The conditions, GTA has a signed HPC lease. GPU clouds are contracted. Neither of those things exist today. So that Canadian $20 per share is not a current value. It is a roadmap of what the stock could be worth if those things happen. My conservative floor is $3.33 US. The gap between those two numbers is roughly $10. That gap is the execution premium. That's the distance between what HIVE has today and what management says it will be. I stress tested the two most important variables, WACC on the one axis and HPC ARR on the other. The range across realistic scenarios is $333 at the floor and $22 at full vision execution. The range is not a hedge, it is the honest answer, in my opinion. At today's price of approximately $5.50 US, the market is pricing in very little execution, which is either an opportunity or a warning. That is the analytical question this investment comes down to. The post-earnings analyst picture. 6 firms with active coverage, all rating buy or market perform. Northland raised from 5 to 550. Rosenblatt raised from 5 to 550. Both citing Q4 softness, but long-term HPC thesis intact. B. Riley raised from $5 to $8, the most aggressive call in the group. Their thesis requires the GTA to land an anchor tenant and Buzz to scale towards the 660 million ARR target. This is a specific, testable prediction. Watch for it. H.C. Wainwright holds a $7 target, the contingent on multi-year GPU deployment contracts executing in 2026. Cantor Fitzgerald raised from $3 to $4.60, valuing the cloud business on 2027 revenue estimates. Keefe Brunette raised from $3 to $5, citing progress towards the $200 million cloud ARR by year end. The consensus mean, it's approximately $6.02. The price target range is $4.60 to $8. The spread of $3.40 tells you exactly where the disagreement lives, not in the mining business, which is straightforward to the model, but in how much execution credit to assign the HPC story. The key upside catalysts the entire analyst community is watching is the same: a named anchor tenant for the GTA Gigafactory. That single announcement would de-risk the execution story and likely trigger a re-rating across the board. Three scenarios. I want to state all of them with the same conviction. The conservative floor, a 50% probability. $35 million ARR only. Mining at 25.1 exahash. Bitcoin at 80,000. Nothing really changes from today. The implied value is approximately $3.33 per share. The current stock price is above this floor, which means the market is already pricing in some of the execution. That is important context. But moderate execution, 35% probability, this is the bull case, 80 million plus HPC ARR is reached, 35 exahash achieved in 2027. GTA gets financed with a named anchor tenant. Bitcoin rises back to 100,000 to 110,000. The implied price per share would be roughly $12 to $18. Then the stretch bull case. They meet the full vision, 15% probability on this. $660 million ARR by end of year 2028. GTA fully energized on schedule. HPC multiple re-rates to 15 times revenue or higher. Bitcoin at 150,000 or above. The implied range is $20 to $28 per share. Probability weighted expected value, approximately $10.52 per share. Currently priced at $4.50, roughly. That spread exists because of the execution risk, not because the business is broken. So 5 things to remember. 1, HIVE grew revenue by 158% in 2026, but the GAAP loss of $148 million is 149% non-cash. The business generated 62.3 million Canadian dollars in operating cash flow. The Bell Canada teaming agreement does not guarantee revenue. The only ARR that counts is the US dollar $35 million in signed contracts. The GTA Gigafactory is land and power, not a funded project. A $3.5 billion Canadian build-out with no anchor tenant is aspiration, not execution. HIVE trades at 1/10 of Hut 8's market cap with the same strategic direction. The gap closes only with signed contracts, not press releases. The conservative floor is approximately $3.33 USD per share. The current price means the market is already pricing in execution. The question is, how much? This video was made in collaboration with CDN Ricky Bobby. If you can find the link to his X profile in the description down below. Go follow him if you enjoy solid due diligence. Disclaimer, a quick reminder, CDN Ricky Bobby and I are not financial advisors. Everything in this video represents our personal research done as a hobby. Nothing here is a recommendation to buy or sell any security. CDN Ricky Bobby is not liable for any investment decisions that you make, and neither am I. Please do your own due diligence. Thank you for watching. If you enjoyed this and want more content like this, throw some suggestions in the comment section down below. Tell me what you like or dislike. Smash the like button and subscribe to my channel. Until next time, happy investing. Thank you. Before you go, if you want to institutionalize your research process, consider securing lifetime access to ALSTOCKTRADES. Founded by Dr. Albert Allen, the platform gives you permanent, uninterrupted access to over 60 advanced analytical tools and more than 40 years of historical data, all without any necessary recurring subscription fees. To lock in this long-term value, click the link in my description down below. Use code DRAGON at checkout and take a massive $2,300 off your lifetime membership. Replace market speculation with objective, data-driven conviction today. I'll see you in the next video.